and you can do the quadrant levels on it. Let's see what I had from Obama. We have $100 million. But we need more money. Yeah, somebody's getting paid. So this line right here, that is the midpoint of the opening range gap. Okay, so it's consequent encroachment, and we are always watching to see if it wants to retrade to that inside of the opening range. Okay, opening range is 9:30 to 10 o'clock. It is not 15 minutes. It's a 30-minute interval. There you go. 70% of the time, it will trade up and touch that mid gap. It matters not for a bias. You don't need a bias. You don't need to have the daily range bias. You don't need to have the session bias. Okay. Right now, you're just studying how price is delivered. I guess it should be done like this. There you go. This should be on the opening price, right? Okay, no, yeah, it's your first day doing this. 9:30 opening price right there. Okay, so we have everything outlined technically, and you can see that that level here is the mid gap or consequent encroachment. So far, a little unorganized in the opening session. Nothing terribly exciting yet. No initial fair value gap formed. Just take a peek. We do have minor sell side here initially. So when it's like this without fair value gap, you can drop down, clear the sell side, and then return back up and hit the mid gap. That's usually a nice little dandy of a profile to study. So that's always in the forefront of my mind when we're watching scenarios like this. Doesn't necessarily mean you have to take a trade, but for the purpose of Caleb, you can watch and anticipate, study, and see what it does. Main thing is just, Caleb, you're building your experience watching price action. Okay, the first order of business is always determine if there's a gap. You have a significant gap. It means it's more than 20 or 30 handles, and mid gap is always our first threshold. Do we want to trade there? Does it do it in the first 30 minutes? And it's 7% likelihood that it does that. Okay, and you can make it exciting by putting an alert. So if it hits that and crosses over by one tick, it gives you that little excitement. Look, that's an alarm bell. Yay! Go ahead and say something. They'll hear you. My wife's. Go ahead and say something. They heard you back on record. Get out of here. Come on, I'm trying to do something. Oh, yes, I'm live. I'm not recording this. It's live. Oh, yeah, it's all right. Anyway, we had lower quadrant trade too, and we can see that here. So lower quadrant here, and that's another roll to the sell side, and then maybe come back to a half closure on the gap, or maybe dig in a little bit deeper. I'm not trying to have a bias so far. I'm going to just sit still and relax and take it as it comes. If you look at the ES, that's even uglier. See that? So it's got this minor sell side to put in here. But in Q, I prefer those down there. So we'll be watching that and see what we get. So the only gap that's used so far for NQ is this one right in here, and that's outside of the opening range. So 9:30, 10 o'clock. We're not so concerned about that. Opening range gap. Extend that over. I'd like to see it tap that one more time at least. Maybe one of these candles hitting it out a bit better. You can still do it in here. So you have this. Let me get a little bit bigger. So far, no fair value gap formed on the 1 minute chart from 9:30 to 10. I did an execution on ES because I have a few students, some of the ladies that is pretty active in leaving comments and feedback. She asked if I could bring in the ES. So I just did that one there today, just to space things up. Now watch that gap here that it used initially there. We went through it. See if it acts as inversion here to send us into the sell side. Be mindful also that technology calendar today we have consumer confidence or time health, I think it's what it is, at 10 o'clock. So we'll be, here you go, look at that. Want to screenshot that? So the setup was here. It's a very small scalp, but still, these things, they build your confidence. It allows you to see things. Not everything that you're studying in price action in real time is an executable trade initially. You have to build some kind of rapport with price, building this kind of like this bridge of communication where you're not just blindly staring at charts and thinking, okay, well, I don't know what I'm looking for. I'll just wait for it to start moving and chase it because it's momentum. You know, that's what cows do and sheep do. Livestock do that. You know, when the husbandman, the person that is raising that animal, and they have lots of them, you know, it's time to feed them. They call for them, and as soon as the first one starts running, they all, it must be the time to eat. That's herd mentality. That's what retail traders do. Okay, retail traders are momentum style, breakout style type traders. And while that is profitable, it could happen for you. It doesn't make any sense to me to do that. It makes better sense if you know that it's likely to have a run. Do the due diligence to determine where the market's going to run to, right? And then try to position yourself opposing that initial run lower. You want to be looking for things to get in going lower. And that would look something like this. Okay, so do we cross over this gap once we went through it? Yes. So these are the first elements to understanding how the fair value gaps can invert, and they change their state. Well, it was used there as support. Discount rally took about the relative equal highs in here, and any buy side was resting in here. The bodies go just a little bit above, send us lower. That gap, it's not inside the 9:30 to 10 o'clock opening range. So I'm just counseling you, Caleb, to look at what it's using while it's forming its first 30-minute range. But when it became apparent that it trades below here, real time, watch this now, it acts as inversion. So if you're using that consequent approach or midpoint of that area here to the low of that gap, which is that candle's high, and you're framing that as a paper trade, or if you're tape reading it, you're not even pushing a button yet, you're watching how it refers to the easiest low-hanging fruit objective to use for price would be the high of that candle. If you look at it up here, upper left-hand corner, it's 19,493 even. So from 493 even to running the low out here, it's 76. So it's going to go below 76. How far can it go below 76? And you go back to the left side, look for any inefficiency, any singular low or relative equal low for actual pending orders in the marketplace in the form of sell stops. But I taught you when you're using ranges like this, a quick down dirty way of doing it would be to do a quadrant for the range you're working within. So there it is. So here's your range from low to high. Real quick, easy target shooting. There's your objective, and it goes down just a little bit below. That's fine. And if you're looking for something that repeats, watching price initially, if you have no fair value gap formed thus far, this is the one that could have formed. And right now, in 9:30 to 10, this is your first presentation right there. So you want to have that noted. But it wasn't giving us anything yet, so my attention had been placed there. You were all watching it. Let's trace from here. If you go from the 493 even as your hypothetical tape reading or hypothetical demo entry, or that's your actual trade entry, you have 493 high on that candle, which is the easiest one to reach to once below, so it trades up into that. And then below this low, one tick below that, that could be a partial, and then you do your one quadrant extension of the range, and it'll give you 460 and a quarter. So what's that, about 30 plus handles? That's pretty good. That's better than the average YouTuber. So I'm not trying to be derogatory when I say that. I'm just stating that the folks that you're probably used to seeing take trades, that's well within the realm of reasonable. It's beyond the scope of what their study guide is. I'm convinced they're studying my stuff now because they're starting to get a little bit longer runs, which is what I want them to do. I want everybody out there. You don't have to love me. You don't have to even co-sign and say I'm using my stuff. I can tell you using my stuff. Other people can tell too. I'll never troll you. But all I want to do is see you guys do better. And guys doesn't necessarily mean male. The females do. All right, so we have that gap right here. I have to annotate that. So you have to be mindful of this one. And you want to extend that out in perpetuity throughout the day. And we'll keep it gray man style. All right, and that's the business for today. And then we'll just sit and observe what we got so far here. So we have upper. We had lower quadrant on opening range gap here. So between this level here to the middle of that opening range, the difference between where we stopped trading yesterday at 4:14 p.m. to where we open at 9:30 today, Eastern Standard Time. That gives us our gap, and you want to put your quadrants on it. You went to the lower quadrant. Could it trade to the midpoint? No. So far we have initial heaviness, and we want to really pay attention on how we trade here after breaking through this sell side. If we start to climb back up, midpoint is still a measure. As long as it doesn't come back up here, this is going to stay heavy all day. This is actually no, it's not. I apologize. It's confused you. Trying to talk about this stuff and draw all this stuff on my chart when it's not necessarily there for me. It's a little cumbersome for me. So there is your 9:30. The opening tick is where it's at. So that is the opening range gap low. So if you've been looking at that, you're wondering, what is that? That doesn't make any sense. It's because I'm trying to outline everything, also reading it over a 1-minute chart, and it's a lot to do. It's a lot of plate spinning right now. So the same logic. All right, so we had one more reach down below short-term low. 15-minute time frame. Okay, so we have this low here. So last Friday's 8:30 low. You see how clean that is? Right here. I believe that might be something that we could be using soon. I'm not going so far to say it's for today, but that is something that my eye is really drawn to when we drop into this time frame. So it's like it snaps right to that. So just be mindful that we could visit the 19,105 area or thereabouts on the 5-minute chart. Okay, and this one. Like that. A little bit of animation. Now this can reverse its role again, so we get back above it. It can go right back into what it initially started as, something to look as a discount when it was here. Hit it, rallied higher, went through it, inversion, break lower, trades back above it. Remember, this is first presentation here. This fair value gap is the first one inside of 9:30 to 10 o'clock. Okay, so we are inside the first fair value gap of the day. Still inside opening range. Half of the opening range gap still yet to be traded to.
Order filled.
I have a lot of new students leaving comments. Why do you show examples in demo?
Order submitted.
I don't always show just in paper trading. I don't always show just demo trading. I have examples of trades where I've used a live broker with real money. It's not demo, it's not paper trading. But because you're probably new, and you probably never heard me say this, and because you're asking brand new, which video should I watch? That means you probably didn't hear me say what I'm about to say here, but other people know about it. In the United States, there's a governing body called the CFTC, Commodity Futures Trading Commission, and they are kind of like the police of the financial markets for futures and forex. And I'm not a licensed trade advisor or financial advisor, so to protect myself and you as a viewer, I teach in the medium of paper trading or demo trading. But when I want to show, and I've shown with real money, real live account, you can look at it in the lower left-hand corner. It'll say AMP, or you can go look at the TD Ameritrade playlist where I literally logged in and showed 3 months of every fluctuation in price. But it's for my protection. I don't want to get in trouble financially or with the legal watchdogs like CFTC, NFA. And the people that are new to this stuff are just dumb as rocks. They don't get it. Like everybody out here that's pretending that they're educating people and not really putting the disclaimers up and reminding folks that it's for informational purposes only, they're really putting themselves in jeopardy of being tapped by one of these bodies, which are essential. Now we're touching. We went above the initial fair value gap here. Came down to this, hit it. So I would like to see, do we have the ability to run back into the gap here? Buy side is here, and then the 7% likelihood of hitting that midpoint gap could come to fruition before 10 o'clock. But it's to, like, I don't need you if you're brand new or if you're just hanging around or whatever. I still get 1 or 2 comments. Oh, it's just paper trading. Oh, it's just demo. So I want to see you come out here with a demo account and call every little tick and trade them with a very small stop loss and show beforehand, explain it. This is what it's going to do and why. And it nullifies, it cancels out your argument. Because if I can't do it in this, where it protects me to teach the concepts broadly, and it's not deemed as financial advice, I'm not giving you trade signals, I'm not putting you into a trade where if you use real money trying to copy me, and if you lose, you could, if I was pretending to be a financial advisor, and I'm saying I'm doing this with my real money right now, I'm enticing you to do something and acting as a financial advisor when I'm not licensed to do so. If I did that, that's the reason why I don't do these things. I like teaching, but I'm not trying to have things put against me because people are irresponsible. So I'm the one being responsible in our relationship. So see the reaction off of the initial fair value gap. So this is the first presentation. We opened. I told you, when we go back above it, watch this here. It hits it, bang, run to short-term buy side, 7% gap. Just fell short of it. I think she'll hit it. I think she'll hit it.
Order
I like to trade
submitted.
laughing because some of you think I don't know how to trade, and I like to do this. Yeah, Patrick? No. Full flag required. No trend line breakouts. Back into the opening gap on the 27th, and then opening range gap high, which is previous day's settlement at 4:14 p.m. That'll be a full gap closure. So I've already had 3/4 of the gap closed. The remaining portion is there. Okay. So easy for me to say. 70% of the time, between 9:30 and 10 o'clock, whenever you have your opening range gap and it's more than 30 handles, you have all the things, on the checklist. Okay, it's likely to do what? Draw into that gap. How much? Half of it minimum. You got 70% chance that's going to happen. Now let's roll back for a moment. If you are expecting that as your model, okay, say you were heavily bearish. Maybe you were fading it and you were trying to say that it was going to use this as a sell-off, okay, or you were going short on something else, and it was running out. I said, we get above here, watch and see if we get above this initial fair value gap. Then we had it go above it, close above it. We opened, traded down, hit it perfectly to the tick, and then starts running where? To the short-term buy side. Why? Because we've upset the sell side down here. So where the waters were smooth, there was disturbance. Okay, so the predators, the sharks, if you will, they ate. Okay, they took their pound of flesh. So now we're going to cruise to where it's smooth. Where it's smooth. See these candles over here? See how smooth that is? And then right over here, all of that is too smooth. We're gonna have a full gap closure outside. The to the buy side there, and then we had half of the gap still undelivered. We hit it, and then expand up into 3/4 of the gap between this big broad black line and this black line here. So we have the market using that first fair value gap as your full gap closure. So you can use this as a study, much like we just did over here, from here to the 1 quadrant of the range from here to here. So you see me trade both long and short in the same day. And I'm giving you a very elementary way of starting how to see it and watching it over real-time price action, giving you the things to look for. You're not trying to pick every entry point. But while you're watching price, what constitutes a setup? What constitutes a valid run from a particular that can be predicted? And to the young man that's made a video, I'll refute ICT's claim that there's an algorithm delivering price. Well, look, you're telling me buying selling pressure or your garbage is what causes these moves? Like, if it wasn't an algorithm and I didn't know what that algorithm's doing, I could not have the confidence and the track record of sitting out here in front of everybody live over the lowest latency and the lowest time frame, which, by the way, folks are asking all the time. I want to know what time frame you use. That right there tells you it's a 1 minute chart. Okay, so if it's 5, it's 5 minutes. If it's 15, it's 15 minutes. If it's 60, it's 1 hour chart. So you would look at this and study this with, in my opinion, it should fascinate you. Because let's just say for a second that you're going to argue the case that there is no algorithm. And you're tolerating me when I say it because you don't want to subscribe to that. You believe something else. Your brother's cousin's, sister's boyfriend is a guy on Wall Street. And he's claiming that this guy on the internet is talking to you, telling you every little fluctuation tick in the marketplace. Every single time frame. Literally executing on it. Literally executing a live data feed, not market replay. Okay. Easy to do in market replay, the guy says in my comment section. We're going to prove that wasn't market replay today. But you can't escape it. Okay. You cannot escape it. It is algorithmic. It's 100% controlled. And if you try to argue that, the only thing you're succeeding is you're saying to yourself and to everyone you can be heard, that can hear you, that you are a nincompoop. Like, you are such a moron to sit out here and say that it's buying and selling pressure, because buying and selling pressure is based on randomness. That is randomness.
Order submitted. Order filled.
If I have a direction and I tell everybody, look, we're all going to a destination, okay? Follow me, I promise you. It's
Order submitted.
Not everybody's going to follow me. Not everybody's going to follow me. But some individuals will start out following me, okay? And they'll think, oh, he's probably going to this destination. He's probably going to this point of interest in the town, okay? Some local hotspot. Now, I haven't disclosed what that is yet. I just said, it's going to be exciting, follow me. That's essentially what price is doing every single day, every given moment. And traders make a decision to follow price attentively, and some of them try to stay right behind price and they chase it. That's momentum trading, breakout trading. But then you have the others that say, you know what, I don't know what's going on here, and I'm not interested in this. Somebody else is doing something else, and they claim it's going to be a better thing going the other direction. So Kanye's going downtown, I want to go down there. And this guy here, he wants to watch Celine Dion. Okay, who knows? Okay, whatever the initial draw is, okay, you think it is. It's the same thing as saying you believe price is going to go to this level above or this level below. Now, if I am trying to get as many people involved to follow that price run up, so that way I can build positions against that run, okay, this is what the algorithm's doing. As price is going higher, you're led to believe by books and people on the internet and people that want to watch my videos and get clicks and engagements and sound smart. They want to sound smart. They want to be an argument to it. But they're not going to get out here and call the price by every fluctuation like this and use their discipline, their school of thought. They're not going to use Wyckoff. They're not going to use supply and demand. They're not going to use elite wave. They're not going to use anything because all that stuff has nothing to do with why price is going to go up and down, why it stops, go tick, how you can discern where it's going to go, why it should go there, and what time should it do it. So to make the argument that there is no algorithm and see this being done in a live setting, explaining the logic of what it should do, why it shouldn't do this, and then watch this next behavior. Right when it does this, you're saying that everybody stopped selling short. There was no more sellers willing to sell short.
Order submitted.
And it was only the imbalance of buying that stopped it right to the top of the fair value gap that I told you. Now, for weeks you've known about it, if you just been watching this mentorship. But I told you in Twitter Spaces in 2023, the first fair value gap after 9:30. That's the one I'm going to drag across throughout the entire time of the day. I don't put my Twitter Spaces on my YouTube channel. I don't care to have one because I've talked about topics and things I just don't want on that YouTube channel. But I've given permission for everyone to Twitter Spaces. You all can upload them, make money off of them. I don't care. But the lectures, you cannot do that. I will go copyright against you. And there's a Chinese ran YouTube channel that they wasted this evening. She's converting everything into Chinese. I don't get permission for that. So you don't lose everything tonight. But the buying and selling pressure did not cause that stop right there on that candlestick. It absolutely did not do that. What's actually happening is the market is delivering that price. It doesn't matter how many people are buying and selling. It's going to stop because it's stopping on its code. It says, I'm not going to go past that point. And I'm showing you what that looks like visually before it does it. So anyone with common sense and rudimentary math, and if you've ever studied anything with computer programming, I'm a little surprised because I thought that we had in math and science a lot more involvement with programming. In some schools in our area, we had a little bit higher, in Harper County, a little bit higher degree mathematics and schooling on the public level. And my kids, they were introduced to computer programming. It wasn't like they had to elect it. It was just they did a teaching on it, which I thought was great. And for me as a child, when I was in 6th grade, I was teaching myself how to computer program. I was making my own games and little password things to get into files that I would protect using just basic language. And I was fascinated with how things work. So it makes sense to me. And every single person that is in computer science or has ever had a background in or any involvement in computer programming, when I teach how price is booking, how it refers to specific levels, it's the same thing that they understand by understanding how coding is done. Because the market is absolutely one big program. It is a controlled environment that sometimes can be manipulated and disturbed, and that's manual intervention. Barring that, it will act and behave the same way all the time. It's doing time-based delivery. The speed at which it does it is in direct relationship to
order filled.
efficiency or liquidity is to market price, meaning this. We opened, we traded down. Now, I had this on this chart in front of all you. I told you we hadn't made one until that was when we had our first fair value gap. That right there, when we went above it, traded back down and stopped dead in its tracks. There is no buying and selling pressure influence. Now, when buyers and sellers come into the marketplace, if you wanted to sell short below that price, you didn't get the opportunity to do that. It never gave you your fill. If you wanted to buy below that price, you did not get the fill. You're telling me nobody had an interest to buy a little bit lower than that? There was no interest, absolutely no interest at all. No buyers had any interest there. No sellers had any interest below that. Think about that. Listen, I love talking about this because I love rubbing everybody's nose in it that thinks that there's no algorithm because it's like I get off on this. I literally get off on this. I'm not mad. I don't feel insecure because I can do this every single day and prove that there is one. My hands are all over it. Okay? I can't say anything more than that. I mean, it can't be plainer than that. If I don't know what I'm talking about, it's going to be obvious, right? It's going to be obvious. But if I keep talking about things that are not germane to anything else out there, just like people say it's been renamed, that these concepts are not my concepts, they're renamed. Where are the other concepts? Where's that logic? Because then what you can do is go into that logic of that supposed renamed school of thought that I supposedly changed the name of, and go in and look at the mechanics behind that and see what is that doing. It's because there's nothing like that actually occurring. There's nothing me renaming. I'm not borrowing somebody else's logic and calling it something different to impress you. I've invited all of you to do it. Go look and investigate it. You will not see these things. You will absolutely not have time-specific things. You will not have specific price delivery. The PDA rates don't exist in any other form or school of thought and trade. It does not exist. It doesn't exist prior to me. And I say that because I want you to go in and study and look for that, because if I'm lying, you'll see that I'm lying. But guess what happens? You find out that there's nothing else like this. And then you start looking at me do it live, explaining this is what's going to do, what's going to do, how's it going to behave. Look at what I just did this morning. I traded ES and I traded NASDAQ. Okay? I executed with a level of precision that no one else displays. It never, ever, ever happens. That should comfort you. That should comfort you. If I never do another live stream, but I'm going to be doing live streams obviously, but if I never did another one, you've seen enough. I would have been satisfied with this. Like, you know what? There probably is an algorithm here. And I might not ever learn everything about it, but I have seen enough to know that I can exploit. I can exploit these very things that happen, and they tend to repeat. And they're not surprises when they do. Like, I'm not looking at price saying, oh my gosh, look at that. Huh? Look at this right here. Look at this chart. Look at the price. Where did that come from? But I wasn't expecting that. I'm so excited. Or I'm so scared. Nothing like that happens for me. That doesn't happen. It's boring. I know what I'm looking for. My students have been trained to look for these things, and you're learning more. You're learning more details. And it's exciting when you understand that if it's rigged, okay? If it's rigged, that is has a home field advantage. You really think that the markets and the people that run them and they profit off of them like a casino, you really believe, think about this now, you really believe in your heart of hearts that they're going to let the success that they hold right now be influenced by the sheer vast interest of buying and selling pressure of Reddit,
order
of
submitted,
social media. They made a mockery of you over Reddit. And I told you all that they would do that with GameStop, BlackBerry. Hello. Buying and selling pressure has absolutely no bearing on where your price is going to go. If you go into a store, you want to buy shoes, you want to buy the new Air Max. Okay, I need new shoes. I'm going to go in here and I'm going to buy a pair of shoes. I wonder what they cost. You don't know, but you're going into that store. So you're doing what? You're following the lead of the draw. The draw is you want shoes. Maybe you don't need them. You just want them. But you are going to that store. That's the draw on liquidity. Your liquidity. You don't see it that way, but that's how I see it. I'm smart money. I'm cannibalizing you. And I know that I'm going to take price higher, but I have to have fulfillment. There has to be handshaking between a counterparty of buying and a counterparty of selling. Smart money will follow with one algorithm that trades and engages with the price engine that is the algorithm. So in other words, think about it like this. If there is a mechanism that causes the fluctuation of price going up and down, okay, as we see here, we open, we fluctuate, and we drop lower. Okay, we went down below here to absorb what? The sell orders. What vested interest would there be for an entity that we're going to classically refer to as smart money? What benefit would that be to go below here to engage these sell stops? It's not for the express order of letting those make money going down. That's not what it is. It's for smart money to accumulate the sell stops that are resting below these relative equal lows when there's an unfulfilled range up here and unfinished business, that range that was created by the imbalance of the opening range gap. So previous day settlement, which is this heavy dark line here, okay, noted here, that's 4:14 p.m. Eastern time, last print. And since its session ends at 4:15, you're not going to see a price at 4:15, so therefore it stops at 4:14. It's still trading electronically until 5 o'clock, and it stops and pauses for an hour and resumes at 6 p.m. Eastern Standard Time. But we drop this area all down in here is the market providing ample time. It's providing opportunity for smart money to absorb and be counterparty to those sell stops or sell orders that sell in a breakout lower. So all this here, all of this is accumulation of individuals that want to be sellers. Now, they could be selling to protect a long position, or they want to sell in a breakout as it drops down like a momentum trader. It doesn't matter. We don't care what type of classification the sell orders are. We just look for relative equal lows. Okay, that was my point trying to create this language. I have tools, and I can discern how much of the buying and selling pressures, okay, you're going to use those terms, above or below, highs are, how much are pending orders for breakout or continuation, or stop out and be neutralized on an existing pre-positioned trade. That means buy stops taking out shorts, sell stops taking out longs, or sell stops, new entry for breakout, buy stops, breakout for new longs. I have ways to determine that. But that stuff, you're not getting that stuff. So to create a language that allows us to communicate and understand what I'm saying, and not cross lines I don't want to cross, I use this language of relative equal lows. That's easy. It's visual. They will never stop making relative equal lows and relative equal highs. They're going to be there. It's going to be there all the time. Every time frame's going to be there. But when you have them at times where the market starts to trade and there's a large volume influx where there's a lot of traders coming in, that's why it's easy for people to believe the myopic bullshit of people repeating and regurgitating lies about what makes these markets go up and down, which is buying and selling pressure. The market stopped going lower because it ran out of sellers. What? That's bull. That is bull. It stopped because it's already done enough of a range drop down here. There's enough absorption of all these sell stops. So the market is affording people that need large pools of liquidity to be counterparty to their trades. They can't fulfill the measure of volume that would be allowing them to profit efficiently because they're trading large amounts of money. To get back to that full gap closure of yesterday's 4:14 p.m. Eastern time, that line right here, to get to that price and the volume that they're trying to shove through the marketplace, it's not efficient for them to be buying most of it as it's going up because the delivery to terminus is already started. They have to do it when the market's going against it. If this is where the market's going to go, and I'm teaching that to you, focus on the initial opening range and where that opening range gap, if there is one, because it's going to have a 7% chance it's going to fill half of it in the first 30 minutes. That in and of itself is algorithmic. You don't hear people teach that in books. Find it in a book. Find it. It's not out there. It's going to be in everybody's book now, but it's not out there. You're familiar with opening range. Oh, opening range, oh, it's this, that. You're looking at different time frames, 15 minutes, 5 minutes. That's bullshit. It's 30 minutes. That's what this algorithm is referring to, okay? If it won't hold up to scrutiny with me calling it out on it live, that means it's not real. That means I'm a fraud. That means it's fake. It's made up. It's contrived. But how many times are you seeing it work? Perfectly. That's my emphasis here. Because I say this not to defend myself. It's for the folks that tell me that they're being influenced by other people because they're so new. And I'm just saying, don't believe me because I said so. Never believe me because I said so. You listen to me, determine what the parameters are to go into the marketplace and see it for yourself. Go back. It doesn't take long to see if there's anything here about or not. And go into live streams. If you're brand new and you're trying to learn how to do what I'm teaching on this YouTube channel, there's no better way to start than what you're doing right now in 2024. Because I'm literally proving, unequivocally. It's irrefutable. It's absolutely irrefutable. I can do this in front of court. I can do this in front of the Supreme Court. I can do this in front of the CFTC. I can do this. I'm doing it live right now. They're probably watching. Hello. Hello, Lydia. That's who was the lady in charge in the 90s when they served me paperwork at my aunt's house because I wasn't putting risk disclaimers up because I was stupid. A 20-year-old didn't know what I was doing. I was talking about the markets. I didn't even report the level of risk that's involved. That's why you see my disclaimers in the information box on every video output. That's why you see the disclaimer shown before I start talking to you. I learned that lesson in the 90s because the federal government literally said, hey, you don't know what you're doing, bud. And I got stopped. I just said, okay, I'm not doing that until I learned that these are the risk disclaimers you have to have. That's why when I reach out to other YouTubers and I tell them, look, you're potentially in trouble here if you don't start doing this. And a lot of people laugh it off, but eventually they start using it. That's all. I don't want to see anybody getting in trouble because our government sometimes has a little bit of an overreach. And while I wasn't doing anything to cause anybody losing any money, in fact, they're actually making money off what I was saying. I was teaching before I should have because I didn't fully understand everything I was doing. Clearly indicated by me not revealing the disclosures of risk that needs to be given to the public. So there's a lot of laws, folks. There's a lot of laws and regulations, and I love doing what I'm doing, but I'm not going to do something that's against the law. I'm not going to go out here and put myself in jeopardy just to impress you.
Order filled.
But I say these things and I talk about the algorithm because they're students that are brand new.
Order submitted.
And it helps reinforce what I'm already teaching anyway. It's not like I'm saying something you can't learn more information about or feel more confident in. I mean, I understand some of you will say, well, we get ICT. Can we move on? We understand this algorithm. But the elements of every individual day and how it delivers, I'm revealing that to you. I'm giving you the mechanics of it. And buying and selling pressure, the markets are for the deep pockets. They're not for you. They're not for me. They're not for John Q. Public. You know, the stock traders, the old ladies that sit around the head of the stock buyers club. It's not for them either. It's not for them. It's for these deep pockets to fleece you because we are all cattle to them. That's the reality. And how do we get to be a part of the same game they're running? Use what I'm teaching. And it's literally, you cannot refute it. It's there. Now, the folks that don't believe in algorithm, they'll have to backpedal and say, well, he's just a really good price action trader using other people's stuff. And my question still is, where's the other people's stuff? Where is that? Where's the rules that I'm giving you, the time elements? That's not anywhere else, okay? I'm so sick of hearing go box. I ain't seen one person come out here and outline the profile of the day, the time at which it's going to behave, where the imbalance is going to form, how it's going to be utilized, stop on a tick, use a stop loss, put a stop loss on your trades, make them tight with logic that repeats. It's already been taught in this YouTube channel, okay? But find the other logic. It's not there. But it's so easy for people to be influenced because they watch somebody else say something. Oh, and the more emojis in the comment, it must be valid then. Like emojis, in my opinion, they invalidate any argument. As soon as you start putting emojis in your post, I already know I'm talking to a kid. I already talking to a kid, and they're clueless. So deep money, smart money, big players, okay, they have to have the opposite end or counterparty to their intended trade. Okay, so in this case, it's the sell stops below these relative equal lows. So the market drops down, which is interesting because we only have a little line where run above and it drops. Then it gives you the fair value gap here. See that? Drops into the sell side, spends time down here. Where is their inefficiency? When it goes below these lows, at this moment, right in here, at this candle, where is the inefficiency in the marketplace? There. And the remaining portion of the opening range gap that was yet to be filled from that high up to that dark line. So there's unfinished business up here. So they're tipping their hand to you by dropping it initially. What's the most time they spend on the sell side? They're accumulating. Remember the other day I was telling you we were watching price action. I said I don't want to see it accumulate inside the constant approachment of the wick of the candle, and it went down, stabbed down there, and immediately came back out of it. That's the opposite of this. This is accumulation. Accumulation is the market spending time. It has to spend time at a predetermined area where liquidity is, where inefficiencies are. Inefficiencies are best suited and used one time, right in there, quickly, hit it, and run. It can be used again, but we don't want to see markets go into inefficiency like a fair value gap here. Like we don't want to see it go up here, meander around, create a bull flag, right, Patrick? No bull flags required. Okay, we want to see it trade to it, through it, come back down, treat it as what? A springboard. Rocket fuel, baby. Send it higher. Inefficiencies, we don't want to see it spend time inside them. Liquidity, when you're going to be trading with the daily range or the largest magnitude in price delivery, which side is going to move on most? Okay, the more time it spends below a pool of liquidity, it's obvious like that. That's allowing and affording smart money to do what? Load it up. Load it up. And then it starts to reprice higher. Smart money is not buying as it's going up. They will buy right there. Why? Because it's coming down to that inefficiency. And it's affording them still a range to get to full gap closure. See that? So it trades down to the top of that, stops right on the tick. What is the low of that candle? You're going to be looking at this value right here, upper left-hand corner where my cursor is. See it? You're going to look at that value right there. That low comes in at 19,505.25. Okay? 505.25. The low of that candle comes in at 19,000, ready for it? 505.25. But there's no fucking algorithm. It never gets old. Come on, Mr. Option Dude. Come on. Come at me, bro. So good. Oh man, I'm so entertaining. I love it. I can entertain myself every day. I wish the market straight goes out. I'd be good at it too. That's perfect. Tell me where Mike out there gave you perfection. Nope. Elliott Wave never happened. Supply and demand. Who the fuck knows inside those zones you're buying and selling, right? What price is perfect in the zones? Nobody knows. But there's this old guy. This old dude in Maryland. He's got a really good lucky rabbit's foot up his ass. It's unbelievable. It just keeps repeating. You can't keep getting away with it, right? Anyway. So we're back inside. Remember I told you when these form, it's like a huge black hole. It's going to draw price into it. Keep pulling in. So if you ever see nested new opening gaps, or vice versa, and this is just a beautiful, this is like a poster child of the event I'm telling you about, where it draws price into it. So smart money has to buy where there's liquidity. Okay, they're absorbing counterparties, and it's never going to be hidden from you. Below old lows, there's going to be sell stops. Okay, above old highs, there's going to be buy stops. When you're watching price action, okay, when you're watching price, you're trying to get a feel for it, and you won't know how to do this initially. You won't have a feel for it for a while because it takes experience seeing and reading price action live. And you'll get the rules that I'm teaching you, and you'll start seeing example after example. Take a screenshot of that, by the way. Such a beautiful element of delivery right there. It's such a good thing. Man, it's so good, isn't it? Isn't that beautiful? Where suddenly all this stuff makes sense. It gives you a rhyme and a reason. It gives you a script to expect price to adhere to. And once you understand that script, what it should do, how it should behave, if it ever goes off script, guess what that means? It's not a time to over leverage, right? It's not a time to get in there and press the button. You need to sit still. There's something going on. There's a deja vu moment there, like in the Matrix. Something has changed. And that is not always an invitation for you to be doing something in the market trading. So smart money has to buy down here because of the volume that's required to be counterparty to their trade. So if they're buying,
Order
they want to be a
submitted.
buyer, they're going to be buying in large pools of liquidity. And they will add, as the market trades up, but it has to be on sell side delivery. That means momentum, delivery of price going down. They will never, ever buy on an uptick. It never will happen. It never happens. Smart money's never buying on breakouts. It's not happening. It's never happening because they have to have discounted prices. So this down close candle is the first discounted delivery from the perspective of looking at all these up close candles. Even that's a small up close candle. So this just so happens to be at a fair value gap. I told you conceptually that it will be formed between 9:30 and 10 o'clock. It's the first one. And then because we spent time on the sell side, accumulated, we want to see it run above here and watch. Does this treat this same range? Does it invert that? Because remember, it was over here. When price is up there, it drops down, uses it, then springs higher. Goes below it, inverts, goes down here. Now watch this level here because it's going to do what? Change its character. It's going to revert back to what it was over here. Then this now becomes what? This is now a reclaimed bullish fair value gap. Why? Because it was acting as one before. Where did that happen? Right there, folks. So stop saying I did something wrong in my lecture. I did not call that fair value gap an inverted fair value gap incorrectly. It was how it's used. How is it used? And does it change its mode of delivery? How is it influencing price? So this has become a reclaimed bullish fair value gap because it should have been treated as such over here if the underlying narrative is bullish. So that's what I'm saying. When people say all fair value gaps are the same, you're an idiot. You have no idea what you're talking about. Stop talking like you do because you have no idea what you're saying. And stop trying to teach them. Say this is how I use them with my present understanding. You know what? That's very disarming. It's a fair statement. No one can look, especially on the off-road. I can't look at that and you know what? He's pretending to know something he doesn't know. Because everybody up to this point that's ever taught or lectured anything about fair value gap, trying to teach it, you literally have no idea what you're talking about. You literally have no idea. You haven't spent enough time with me. Seriously, you haven't spent enough time, and I haven't taught everything about them yet. You're just introduced to them. You're familiar with them, like, oh, I've seen it before, but you can't explain it. In hindsight, you can with market replay, you can do that, obviously, because you have benefit of saying, well, it behaved that way there. But I'm telling you where they're forming before they form. How they're going to react. Can you argue that? Make your videos today. Expose me today. Go on YouTube, make your video. Make sure you put the @ inner circle trader, all one word, and I'll see your little video, okay? And I will gladly come to your channel, and I'll leave a comment, because that's really what you want, and we can all laugh at you, okay? Because there's no way you're going to argue this today. There's zero way you're going to argue out of it, because it's given to you beforehand. The logic, how it's going to behave, and then what it looks like. You've seen that, but how and when it's going to form. How will price react? How is it going to react off of it? And it's not. There's no more sellers here. There's only buyers coming in. Only buyers are outnumbering. Think about the stupidity of that statement.
Order filled.
Okay? So there's an imbalance of buyers. How the fuck is that possible? Because for someone to get long and filled, they have to have a counterparty that's sold to them. That's how the markets are working, right? Look at your depth of market. Look at your DOM, okay? Not DOM. Study them. Not for the express purpose of learning how to use them to trade with, but look at the facade they present to you. There's just numbers there. Those orders are coming and going. Maybe they'll be there when the market prints that price and books the market. Maybe they're not going to be there. It happens all the time. Market participants, Goldman Sachs, Citi, any other large conglomerate, they could put an order in and say, I'm going to pull the order for whatever reason, and you can read between the lines on that. Some entity out there could do things like that. And
order
canceled. Give you a false impression that there's a lot of interest at this level, and things like book math and stuff like that. If you know that there's a large likelihood, okay, from a narrative perspective, that once we are down here and there's a large pool of orders that you see on the depth of market that's below this area down here, and we start seeing this right there, I'm telling you that doesn't matter that there's so much orders below here or at a lower price. But see, some of you think that that's somehow a magnet that's going to cause the market to say, look at the number, look at the sheer number here. When that's not really what's going to be pushing price around. It's understanding how the market's going to work with what's been given to you in the first 30 minutes. Using the footholds with these PDA arrays, this was the sheer mountain, side of the mountain, okay? You go down. You got to climb back up top of this and get to some zenith higher level, the undelivered gap opening. Well, as you go up this range, you have to look inside here. Where are the footholds? Where are you going to reach for? If your price, and I'm going to personify price as your price, and you're down here, what does it have to do? It has to get above this first. Well, that's an easy one. It gets above that, no problem. Then you have an old foothold here. So you use it, pull yourself up to it, and once you get above it, now it becomes a foothold. So the handhold first, and then it becomes a foothold. Oh, he's just talking about supply and demand. He's just talking about support resistance. Well, did you call this beforehand? Did you trade it? Did you live stream it outline it live? That it was going to behave that way before it did it? This is how you cancel anybody that's challenging you with the intended purpose to discourage you. There would be no way anybody could discourage me from learning this from someone like myself doing this live. There's nothing anybody could ever say. They say, you know what? I ain't listening to that guy. He's shady. He's a shady guy. You never trade live. I'm going to trade live. But I got to give you a logic. What I'm using, because otherwise you're going to be like, I don't understand why you did that. Because it's the same stuff I'm showing you every day. But you have to get comfortable with this scale. You have to see it repeat over and over and over again. And by seeing that without any money, without any clout behind it, whether you win or lose, without any, I'm going to impress dad or I'm going to probably disappoint dad behind the execution, you're just observing price. So that way there's no heat on you. There's no pressure. There's no requirement for you to be right. So you're just observing what price is doing. And these things that I'm teaching will repeat and repeat. So back to this. So your price, I'm personifying price with you. You're the individual that is price. When you're down here, it's got to get above this high here. It's going to get above that rather quickly. Why? Because that is a shift in market structure. You want them to be sudden and abrupt. Just like that. Okay? When it does this, your eye goes back to all of this range. Now this range just so happens to use reference points that was given over here. So this is a PDA array that can change its characteristic and role of how it's going to behave, either impeding price or supporting or rejecting price. Meaning, it was a potential bullish fair value gap. That was realized right here when the market dropped down into it and then sent it up. Then we went down through it, excuse me, making this a inversion. So it's not bullish anymore. It's going to use to send price lower. It does so. Then the market starts to come back up. Abruptly, shift in market structure. What's your first PDA array? Well, you're in one. It's the old bullish fair value gap. So now it's reclaimed. Why? How's it reclaimed? Because it went above it. And we're opening here, trading down into it. It should act as what? Support. Real support. Not the stuff you see in books, and it's not supply and demand. It's none of those things. Wyckoff has nothing to do with that right there. Wyckoff, if he was alive, he's writing notes right now. He's in the same classroom you're in. He would be writing notes and sending me emails saying, what about this and what about that? He'd be doing that. And that sounds arrogant, but that's just the fucking truth. So the next thing is when we get above it, we get into this gap here, which just happens to be the first fair value gap that forms between 931 specifically to 10 o'clock, because your fair value gap can't form on the 930 candle. Okay, so there's a rule there. Find that in your books. So once we get above it here, opens, trades down to the tick, stops. Smart money can add in that, but they're not adding the volume of orders that they pushed in here because it's not enough time and or liquidity offered to counterpart with that. You see what I'm saying? So when the market is allowing and affording in pools of liquidity, when there's a gap that's yet to be filled, they haven't even touched the halfway gap or constant version of it. And you have this big, huge black hole of a new day opening gap and a new week opening gap. How many times has it been trading back and forth to it over the last couple days? Think about it. Think. It's not one and done. It's not pivots. It's not floor traders pivots. Okay. Oh, it trades the R1, R2. Okay, well, it's done. Totally. That's not the logic we're using here, is it? This is what the algorithm refers to. These are old reference points. They are arrays. If you are a trader that has any familiarity with computer programming and coding, you know what an array is. It's a reference point where the market, or the market, the algorithm, or program, if you will, refers back to a data point, a reference point. An array is for that express purpose of using something for data, number crunching, what the algorithm's going to do with it, like a recipe. You have all the ingredients. You follow the step-by-step process of making whatever that dish is that you're making, okay? But you are the composite man. You are the market maker. You're literally taking the ingredients and following the step-by-step process of making the outcome how you want it. Sometimes something is a better condition for them to disrupt. And that means that sometimes the outcome isn't always the perfectly cooked pot pie. It may be overcooked and it may be undercooked, okay? But they're still left with a pot pie, right? So they can profit from that. They got something they can work with. What does that mean? If they can't buy as much here, how's that any benefit? Because they won't spend that much time there. Is it going to run out of potential magnitude and speed? In fact, you're expecting it to start doing the very thing, amplifying the directional run and speed, and the candle should start expanding larger. And you get that here, right up into the full gap closure. So they won't get that many positions funneled in the marketplace because they have very little time to do it. But we, as smaller entities in the marketplace, we have no problem pushing our orders into that candlestick right there. Whereas the volume that they have pushed in down here, accumulating a larger position because they see this run here. You can't see that yet. You're learning the beginning building blocks of that. But it starts by having these understandings. Looking for things that are going to be in the marketplace. They cannot hide them from you. Tell me how they're going to hide the first fair value gap between 9:31 and 10 o'clock. How's it possible to hide it from you? You're not looking at the screen. That's the only way it's going to happen. You get a blackout, there's power outage, internet goes down, TradingView or whatever your platform has a wonky technical glitch. That's the extent of it. That's how it's going to be hidden from you. But they can't hide these things from you. If they would change these logics, these elements to it, okay, I would have never talked to you. I mean that. I never would have talked to you if it could be changed by the participation of everybody else. Would you share this information? Be honest for a second, okay? Let's take a moment to drink my water here. But if you knew all this stuff, would you teach it to anybody? And be honest, you might be a Christian, you might be a good person. Would you teach it to anybody else? Let me tell you something. If you say yes, you lie. You're lying. You wouldn't teach it to nobody. You'd be greedy, self-centered, selfish. You wouldn't even talk about it with your friends. So the question is, why am I doing it? Inquiring minds want to know. Say I can't, and I'll make more of you. That's what I said, and that's what I'm doing. In the future, you'll understand what that means. But for now, just know that this is a gift, and you should be very, very thankful for this because it's not worshiping me. You should just be thankful that it's like this in the marketplace. Because if there's an algorithm, if it's controlled, if it's rigged, that means you're never going to be duped by buying and selling pressure randomness. Think about it. How could you possibly sleep at night, laying your head down, thinking, man, I hope I can outsmart all the buying and selling pressure randomness tomorrow. Like, how could, it's like you're playing the lottery. That's stupidity. That's stupid math, okay? That's math that doesn't math. There's no probabilities there. Why would anybody want to work with that? Oh, well, you can do this and you can, bullshit, okay? Bullshit. Show me this and anything else. It's not there. So if we get through these levels here and we have this delivery price and we get above this short-term high, then we can anticipate what? Low, high, lower low. This disrupts what? The liquidity. It absorbs it. This up close candle here is your bullish breaker because it broke the market structure and it took anyone that's long out. So that way now the buy side is neutral, meaning that there's no one long above here. They've taken out anyone that's long here out because they break it down lower. So sell side's been engaged, and now buy side is negative. It's a vast wasteland. There's no heaviness. There's no held positions inside this range here. So they're going to start accumulating when it gets above there. what does accumulation look like? Is it fast, one time, one candle, and then run away? No, that's redelivery. Accumulation in this candlestick right here. Big paradigm shift on already. Fasten your seatbelts. That candlestick right there is your bullish breaker. And we can take this extension thing off here. We'll shade it. Make it green. I don't use that color much. Right? So in here we have that whole run. Now, if you're looking at a PDA array like this, like a breaker, and you're expecting it to offer some measure of support, rejecting lower prices. So it's going to be like a brick wall, saying, no, you're not going to go through me. What would that look like if you have a candlestick like this? We have this big discount tail. Let me move it over so you can see it. See that tail right there from the open of candle down to the low, where it acted off of that fair value gap that I showed you live. Then we close up here. When a candlestick like this for a breaker is forming such a long wick like that, the wick does what? What does the body do in contrast to what the wick is telling us? The wicks do the damage. That means it can color outside the lines. Generally, the bodies don't generally color outside the lines of the PDA. It can, but it's got to be like one tick, no more than two. But a wick can go a few ticks outside of it. But generally, I allow it to have two ticks on an index, like NASDAQ or S&P. S&P generally is like a one tick mohawk, like a little tiny fluctuation above or below the parameters for fair value gap, something like that. For ES, it's tighter because it's a little bit more of a gentleman's market. It's a little bit more refined. The NASDAQ is kind of like a hooker on Saturday night. It's just she's usually drunk and she's a sloppy mess. But she's fun. She's fun to be around. You just don't want to marry her. The ES is a lot more refined. It's a gentleman's market. It behaves a whole lot more tame, and it gives you a lot cleaner price action. And it's a little slower in its delivery, but you can still make a lot of money trading that one too. The ES is not as exciting as the NASDAQ is. I like me a good Saturday night run, and this is what it's like everyday trading. It gives us the opportunity to get in there and have a fast, good time. But you have to wrap up. You got to wear stop loss because you don't be able to mess around with this thing and pick up something you don't want. So when it has a wick like this, I don't know where this stuff comes from, folks. I really don't. I have no idea where it comes from. But that is the body. Okay, so since I'm bullish, I'm going to look at the highest portion of this candlestick. Okay, and I want to be in the upper half of that. Why? Because that's the rules of engagement with my PDA arrays. If I'm bullish, I don't want to see the lower half of any PDA array traded to. I want to see it have the inability to do that. So in the lower portion of something that would be deemed bullish, it should fail delivering price in that. You see the logic there? That's not supply and demand. That's not Wyckoff. That's not anything else. It's a very specific phenomenon that I'm taking your attention to, that I'm using when I'm reading price and I'm executing on. That's what's really going on behind the scenes. So if that's the case here, that body starts here. I'm not worried about that wick. I don't care about it. It's the body. So all of this range up to the high, I have to see what that range is. So it's the upper half, which is this level right here, that line. That's what it's showing me. Okay. So when the breaker's being utilized, it's better for the sensitivity for price action to be between this level here and the high of that candlestick. Now, as price gets above it there, how does it behave? Upper quadrant, upper quadrant, upper quadrant. Can it even touch the halfway point? No. What is the body doing here? Is it spending a little bit of time and then moving? No. What's it doing? Same thing down here. It's accumulating. What's it accumulating? Positions. The algorithm is staying in here, holding it, allowing smart money to do what? Capitalize on that bullish breaker. It levels when you expect it to. Then rallies. Consolidates around what? The high or the previous day's summit price, 4:14 p.m. Eastern Standard Time. That's the high or top of the gap, the opening range gap. So if you trade above it, go back and listen to the other lectures about it. If we're above it, if it's bullish, it'll come down and start doing what? Treating it as support. What is it doing here? Marking time sideways. Why? There isn't anybody trying to buy it. There's nobody interested in going short. I thought buying and selling pressure lose price. Oh, maybe it isn't that. And the market takes a run here, digs into the new day, new week opening gap clustering. How we started this lecture. What is Caleb looking for? Clustering of new day, new week opening gaps. And when you have them in your chart, don't look at them being traded to and delivered to and think they're done, they're dead, they're stale, throw it out like supply and demand logic does. Keep them because the algorithm is going to refer to them. We still have plenty of time to use them. What do you think I thought the FDA ranges were? 60 days is not longer. As a young man that left a comment saying, you said that 60 days, how many trading days is that in a month? If you have 30 days in the month, it's not 30 trading days, but you're using 60 trading days. Look back. Because I've been doing a lot longer, my hands are all over this, and they're my concepts. When I codify these things, I have set boundaries and parameters I want to use as reference points for my use. Mine are 60 days in the past, so 60 trading days. Go backwards. My PDA arrays, depending on how I feel about a market structure and where I think the market may go, usually I'm not looking at PDA arrays that are older than 60 trading days of look back. It's not calendar days. It's 60 trading days look back, and then 40 days. What do you think is going to be more sensitive to price? A 40-day old PDA array or a 60-day PDA array? Well, in other words, a fair value gap that's 40 days old, or a fair value gap that's 60 days old. Which one's going to be more sensitive? The 40-day. What's going to be more sensitive, a 20 or a 40? 20. And if you have PDA arrays that are only, inside the last 20 days, you're working with the actual most active PDA arrays. And if you just focus on them, you never have to make it complicated. You never have to worry about having anything older, because they're always going to be in the chart. You'll see them. They won't hide from you. They can't hide them from you. That's my point to you. Like, you're stressing out all the things that are not going to be that big of a deal for you, and the time and the energy of worrying about it's going to stop working. It's going to be the new retail. There's no traps, folks. Does it look like it's not working for you? Does it look like the person that's created this stuff? Does it sound like I don't know what I'm talking about? I'm explaining this stuff to you, so that way you can go back and look at old news and see that that's exactly how it is, and then you have the perfect opportunity to study going forward. And if it's changing, if it doesn't work anymore, it's going to be glaringly obvious. Everybody will notice it. Not somebody that has something to sell.
Order filled.
So, or make some kind of drama video because they're hungry and need groceries. So that business is closed there. And when we're trading down, the wicks are digging into an old new day opening gap. So, or that's actually yesterday's.
Order canceled.
Yeah, that's today's. Excuse me. So anyway, there's something else I want to say about that breaker. This one, talking about stuff. Yeah. So anyway, the accumulation aspects of price delivery here is when it's spending a little bit of time. When you're in the narrative, expecting high prices, you start seeing these little consolidations in here at the levels I'm teaching you, and at the time at which they should form. So when you start blending these elements together, you get like a really rich tapestry of seeing what price is going to do and how it will behave, and you're not surprised by it. You can anticipate when it starts running, when it starts making big candles in your favor, and then you
Order filled.
Okay, it's moved a little bit now. We can expect a reasonable retracement. This means reversing. It's just going to seek a short-term discount, and then you keep that narrative in mind until you get to around 11:30, 12 o'clock, and then it goes into the lunch macro, and then that's when you expect it to have some measure of